So good morning, everyone, and welcome to your weekly market outlook with me, Geoffrey Gishanga, educator and market analyst at Scope Markets Kenya. I believe your weekend was well, and as we get to step into the new week and also the new month as well, I hope you're going to have a very prosperous month. So starting off, let's look at what you had for last week, the major fundamentals and the trading implications that it had on the various currencies and the various markets. So starting off last week, we had a bank holiday for the pound. Then we also had a bank speech by the governor of the Bank of Canada. We also had the AUD CPI. We also had the unemployment claims by the weekly unemployment claims for the USD. We also had the GDP for the GDP for the USD, and we also had earnings for some major companies. So we are going to have a look at that, and we also get to look at what are we anticipating for this week as we start off this new week from today. So welcome on board, everyone, and stay with me as we get deeper into this. So starting off last week, we had the bank holiday for the pound. So markets in the United Kingdom were closed on Monday, August 25th, in the observance of the bank holiday. So this reduced liquidity in the London trading sessions and contributed to muted global market activity at the start of the week. Then you had the Bank of Canada governor release a speech. He spoke sometime last week. So the Bank of Canada governor, Chief Macklem, confirmed that the Bank of Canada will not change its 2% inflation target when the monetary policy framework is reviewed in 2026. So the 2% midpoint of the 1 to 2 the 2% midpoint of the 1 to 3% range has been in place since 1991. And according to Macklem, this remains credible in anchoring inflation expectations. So speaking in Mexico City at the Bank of Mexico, Macklem stressed that this is not the time to question the target, given the global uncertainty. Remember, there's quite a bit of uncertainty with Canada because of the Trump tariffs, and also because of oil. So definitely there's quite a bit of uncertainty for the Canadian dollar and the Canadian markets. So key considerations for the 2026 review by the Bank of Canada is that one is how to respond to supply chain. One is how to respond to supply shocks amid the US tariffs and supply chain reorientation. So there is just what I've mentioned about the US tariffs and also now the supply chain reorientation. Then how to best measure core inflation when price swings are driven by volatile sectors. So that is also a key consideration for the 2026 review. Then you have the interaction of monetary policy, housing affordability, and inflation as well. Then you have the lessons from the pandemic response. So the policy context is that the Bank of Canada has held its policy rate steady at 2.75% for the past 3 meetings, after being among the most aggressive rate cutters in the G7 last year. So last year they were among all the G7 countries or currencies. They were among the most aggressive rate cutters. So they cut their rates very aggressively last year. So this year we've seen them maintain their rates steadily at 2.75%. So Governor Macklem warned that US tariffs and global supply constraints could exert upward pressure on inflation despite subdued domestic conditions. So there's quite a bit of uncertainty and volatility due to tariffs and global uncertainty, either mostly due to tariffs and the global supply chains. Okay, so that definitely affects the volatility of the Canadian dollar and definitely the Canadian markets. Then coming into the Canadian GDP, we had the GDP release for Canada, Q2 2025. So the real GDP contracted by 0.4% in the second quarter of 2025, following a 0.5% expansion in the first quarter. The main drags, we had a sharp decline in goods exports, then also lower business investment in machinery and equipment. Then offsetting factors, We have business inventories grew strongly. Household consumption increased. Then imports declined, partially cushioning the fall. So per capita, the GDP fell 0.4% after a 0.4% rise in Q1, underscoring a negative productivity and growth outlook. Then you have the final domestic demand that rose 0.9%, led by household and government spending, highlighting domestic resilience despite external trade weaknesses. Okay. Then we get into the Australian CPI. So Australia also released their consumer price index last week. So remember, the consumer price index is used to measure the rate of inflation. So for the AUD, the CPI rose 2.8% year on year in July 2025. The main contributors were the housing, a positive of 3.6%, food and non-alcoholic beverages, that was a positive of 3%, and alcohol and tobacco, which had a positive of 6.5%. So this suggests inflationary pressures remain concentrated in shelter and consumer staples, key concerns for policymakers and households. Then coming into the USD growth, labor, and inflation. So I'll start off with GDP, then we get into the labor market, then we also get into inflation. So starting off with GDP growth for second quarter 2025. So the US real GDP grew 3.3% annualized in the second quarter, revised up from the advanced estimate of 3%. Q1 2025 had contracted by 0.5%, marking a strong rebound. Then, what are some of the growth drivers that led to this result? One, you had consumer spending strengthened. So there was higher consumer spending, then imports declined, providing a net boost. So those are the growth drivers. So what are the weak spots that we saw? So the weak spots, you had investments and exports fell, partially offsetting gains. Then government spending was revised downward as well. Okay. So the outlook, what you are looking out for. This upward revision reinforces the picture of a resilient US economy, though investment weakness points to caution ahead. Then you have the labor market, so the weekly unemployment claims. So for the week, so we had the initial claims. The initial claims are at 229,000, down 5,000, from the previous week. Then the 4-week moving average was 228,500, slightly higher by 2,500, showing a gradual softening trend. Then you have continuing claims, 1.95 million, a decline of 7,000 for previous week, and unemployment rate for insured claims steady at 1.3%. So the interpretation for that is that the labor market remains tight but easing. Then markets are watching whether this gradual weakening could accelerate into a broader slowdown. So that is something to cautiously look out for. But then again, remember that the unemployment claims or the jobless claims are usually released weekly. So you can be able to tell, like, now what will you be expecting for this week's unemployment claims. So remember, again, this week we'll also be having the non-farm payrolls on Friday, which I'm going to get into. Which are going to get into that as we proceed with this briefing. So it's something to closely observe how that definitely will affect the US dollar. Then you have the inflation, core PCE inflation. So the core PCE had a positive of 2.9% year on year, which has been the highest since February. The monthly core increase was a positive of 0.3%, in line with forecasts. Then the headline PCE was a positive of 2.6% year on year, and a positive of 0.2% month on month. So the key dynamics for that is that we have services prices surged a positive of 3.6%, while goods rose only a positive of 0.5%. Energy fell a negative of 2.7% year on year, while food rose a positive of 1.9% year on year. So tariffs imposed by President Donald Trump are feeding through, adding to inflation persistence. So remember, again, we've seen this both on the Canadian economy and now even on the US economy. The uncertainty that is being caused by the tariffs imposed by President Donald Trump. Then the policy implications. The policy implications is that the inflation remains above the Fed's 2% target. So the Fed has been really struggling to bring back inflation to 2% for a very long time. And we had also seen previously how President Donald Trump had put a lot of pressure on the Fed Chair Jerome Powell to actually cut rates to be able to bring down inflation. Now, as we get to now that you've started the month of September, so the next Fed meeting for this month, there is looming speculations and expectations that the Fed is going to cut the rates. We remember that the majority of the Fed governors are also now coming into agreement with a potential rate cut. So this is something that is being speculated, highly speculated and highly expected, a potential rate cut in this month during the Fed meeting. But that is something that can only be forecasted and waited upon. And now we can only see that result happening once that Fed meeting actually takes place. So the Fed officials, including Governor Waller, signaled willingness to cut rates in September, but the size depends on labor market conditions. So this month is key for the dollar. Remember, we have the non-farm payrolls, like I've mentioned, this week. Then you also have the expected or the anticipated Fed rate cut happening within this month. So this is a key month to watch out for on the dollar. Then coming into the corporate earnings sector, last week we had a few companies releasing their earnings. We had Marvel Technology and also we had NVIDIA. So coming into this, I'll start off with Marvel. So Marvel Technology, we had the revenue was at $2.01 billion, which was in line with their estimates. Then the earnings per share was $0.67 adjusted versus the expected $0.66. Then the net income was $194.8 million versus the $193.3 million loss last year. Then you had the data center sales was at $1.49 billion, slightly below the expected $1.51 billion. Then the outlook for Q3, the revenue projected at $2.06 billion, which is a positive of 5%, but weaker than analysts' forecasts. Then the market reaction, the stock plunged 15% as AI demand failed to offset weaker guidance and softer than expected data center growth. Then we have coming into NVIDIA. So NVIDIA reported revenue of $46.74 billion versus the expected $46.06 billion. So the earnings per share was $1.05 adjusted versus the expected $1.01. Then the outlook, we had forecasting $54 billion revenue next quarter, which is a positive of 2% above consensus. So the growth profile. So how does the growth profile look like? The revenue grew by 56% year on year. The revenue grew by 56% year on year from $30.04 billion in the second quarter of 2024. So this marks the 9th consecutive quarter of a positive 50% growth year on year, though at the slowest pace since the AI boom began in 2023. So the data center revenue again fell short of estimates, raising concerns about slower momentum in cloud AI infrastructure build-outs. So then what was the market reactions that you have for that one? So the market reaction, the stock dipped slightly post-earnings, but remains a positive of 35% year to date, following a near tripling in 2024. Okay, so the key takeaways from this. So central banks, Canada and US. So the BOC reaffirmed that the Bank of Canada reaffirmed its 2% inflation target, anchoring credibility. The Fed faces a trade-off between inflation persistence and labor market weakness. Then you have the growth outlook. So the US GDP growth shows resilience, contrasting with Canada's contraction. The domestic consumption remains a buffer, but investment weakness is a concern. Then you have inflation pressures. So with inflation pressures, we have Australia and the US report persistent inflation in essentials like housing, food, and services. Then tariffs are amplifying US inflation risks. Then you have corporate sector. So AI remains a major growth engine, but guidance risks are emerging. That is now for Marvel and Nvidia. Then market valuations remain highly sensitive to forward outlooks. Okay. So that was what we had for last week. So what are we expecting coming into this week, starting from today? So today being the 1st of September, it's the start of a new month and also the start of a new week and a new month. So today we do have the USD and the Canadian bank holiday. So today definitely we'll be having very low momentum and volatility across the dollar pairs and Canadian pairs. Then tomorrow we will be having the US ISM manufacturing PMIs. Then on Wednesday we will be having the Australian GDP and the USD JOLTS job openings. Then on Thursday we will be having the Swiss franc CPI. So we'll be having the Swiss franc CPI. We'll be having the USD ADP non-farm employment change. We'll be having the USD unemployment claims, that is weekly. Then also we'll be having the USD ISM services PMI. Then on Friday we will be ending the week with the Canadian unemployment rate, and the most anticipated, the USD non-farm payrolls that happen every first Friday of each month. So as we get to start off the month and we start off the week as well, let's observe this will be a very key week for the dollar, especially majorly due to the non-farm payrolls. So will you see probably a positive dollar? Will you see a weaker dollar, or will you see a stagnating dollar? So that is something to closely observe as we start off the week. So the week starts with a bank holiday, but definitely will end with a lot of volatility due to the expected non-farm payrolls. So with that, guys, as we start off the week and we start off the new month, I wish you all a very fresh and productive week and month ahead. And I'm looking forward to seeing you on the next one. So stay tuned and have a very blessed and fruitful week ahead. Thank you.